Since we live in an imperfect world, even our trend lines are imperfect, as in sometimes you get false trend line breaks, right? Where it breaks through a trend line and it's supposed to keep going after the break. It's supposed to, not go back above the trend line or not, go back into a trend, right? It has broken the line. There's a rule around that, right? Once the trend line is broken, the trend is over. So that's a very important rule to follow. But a lot of times there's something has happened. Either there's a temporary amount of noise or there's some buying and selling that's caused something to happen that's only a temporary false break as opposed to a true break of the trend line. So we're going to talk about in the next couple lessons. We're going to talk here about how to identify these false trend line breaks, at least give us our best chance at this real vexing challenge. And then also we're going to have a strategy around how can we approach these false breaks and manage them in a better way when they may occur. So first off, let's go back to the rule again, right? Once a trend line is broken, the trend is over. That rule will serve you well. That is a very, very well established rule. And it really takes emotion out of it, takes hope out of it. Oh, I hope it comes back above the trend line. It takes all that out of it. So there's nothing wrong, in fact, very good, that once the trend line is broken, the trend is over, and just stick with that. However, false breaks do happen, where they're breaking that trend line and the trend isn't over. It goes back into the trend, very quickly. So in this lesson, we're going to keep talking about how to identify those. And then the next lesson, we're going to talk about the strategy and how to deal with them as well. And one thing to note about this, the terminology is like a false breakout, but it's actually, they're not false. It really did happen. The trend line really was crossed. It really did happen. But what ends up being false is the conclusion you draw from it. In a way, you are misled. It happens all the time. And we're going to look at how maybe to possibly identify these things so we're misled less. There's really three good ways to kind of look at this. And one is, in terms of how to identify, is did the breakout occur as part of the range or the final close break it as well? And what we mean did the actual close of the day break through the trend line. So for example, if we look at this image here, we've got a downward trend. It's established on the second touch of that downward trending line, that resistance line. And then we get this long, let's say in this case, I adjust a little bit, you see this where we have this long red candlestick with a long high range at the top there where that breaks through the trend line. It broke through the trend line. That counts as the trend line breakage because it did break through. However, the close of the day, which is at the bottom of in a red candlestick in this example, did not break the trend line. It ended up going back into trend, back below the trend line. So that can be an indicator that you might have a false breakout. And it could also be on the upside too. Here you see the next arrow where there's a false breakout, you can see it was actually an up close day. Following the previous day was an up close as well, but it was up in terms of the close, but the close did not go above the trend line. The range did, the highest highs as far as the price range, but the open and the close, and specifically the close, still finished below the trend line. So it can happen in either case with either type of candlestick. And so these are one way to indicate it might be a false breakout where it got pushed up high enough to break the trend line during the day. The rule would say you would sell then, and that's perfectly fine to follow. But if you're worried about a false breakout or you want to push it a little bit further, wait for the close to go above it. And then you can see the last candlestick we have here. Not only did the close go above the trend line, but also the open went above the trend line, and even the whole range of highs and lows, the whole candlestick and its upper shadow and lower shadow, its wicks, all of it finished above the trend line. So that would show, yes, this downward trend is definitely over at this point, and it's not a false breakout. So when the close breaks through, it means it's less likely to be a random event or noise related. That means people are kind of, finishing their positions, closing their positions for the day. And so the close as the final price of the day is more, a much more accurate way, or at least an identifier that this might be a false breakout if it doesn't break through that trend line. If it does, then it's very well established that there is a breakout and the trend is over. Another way you can use in combination too, or use on its own, is to look at trading volume. How much buying and selling is going on, right? So if there's a high volume or a volume spike, that often accompanies the end of a strong trend, whether it's a strong uptrend or a strong downtrend. There's a buying and selling frenzy that's breaking through that trend line, that's causing that to break through the trend line, and associated with that, looking at the bottom of your chart where you've got your vertical bars showing opening, closing, or volume, excuse me, looking at trading, how many transactions are happening. When you see a spike in that and it's breaking through a trend line that you've drawn, then that's a pretty strong indicator that the trend is over. A steep volume decline shows that overall interest is waning and may signal a breakout. Right? It hasn't necessarily happened, but it may signal that interest is waning, may signal a breakout. And if there's steady volume, then it's less likely for a breakout. But be wary, as any cross of a trend line is also significant. So we're looking for a false breakout in this case. The trend line has been crossed. We know that's happened. We could be taking action just on that. But if we see, boy, there's a lot, the volume is not really spiking or declining or anything, it just kind of seems steady, then there might be a chance that this is a false breakout. But high volume, whether it's high or low, may signal that this is a true breakout. So be wary of that. But when it's steady, might be like maybe you can push a little bit further as far as that maybe it's a false breakout. And then lastly, a good tool to use is your other indicators, right? You can use your other indicators to help confirm or possibly disregard a breakout. Like, okay, they broke the trend line. Other indicators are saying the trend's changing. There's a reversal going on. Okay, I got it. If it's an uptrend, I'm selling because not only is the trend line broken, but my other indicators are saying that too, as an example. So using multiple indicators is always a sound idea, and we'll learn about that later as we talk about how you can have primary and secondary indicators and how to use that type of strategy, or a third or fourth indicator. So multiple indicators, can be very helpful, and though sometimes they can give conflicting signals. They certainly can, and that's why sometimes you'll want to give more weight, that you would choose more weight to certain indicators than others, and you'd also want to look at your own risk profile. If you like less risk, then if a breakout occurs, just get out, right? You might want to just get out with the well-established rule. If the trend line is crossed, it's broken through, then you're out. Or if you're seeing a little bit more confirmation, even if there's confliction, if you want to take on less risk, then you want to get out right away. If you want to push it more again and see if this is a false breakout and take a little more risk, a little bit more downside risk, you can do that. Again, this is more about you and your trading style and your plan. And sometimes a confirming indicator can give you an advance warning to be on the watch for a breakout, right? That something might be coming. We saw that in the examples where we saw a nice upward trend line, things were looking great, and then all of a sudden out popped this bearish engulfing candlestick, which is a real clear indicator that a reversal to the bearish, to the downside might be occurring. And we saw that occur. You could see, okay, our range went below the trend line. That's a breakage. We would sell just on that breakage, just on that because it broke. And the fact that it's an engulfing candlestick, or looks like it's one coming, we might have sold just based on that. You'd want to have that next day, that last red candlestick to kind of confirm the bearish engulfing candlestick. But between breaking the trend line and it's getting set up as a bearish engulfing, there'd be nothing wrong with getting out right away in before that. And if you want to wait a little bit more till it fully breaks that trend line, as it did here, and not only with the close also broken, in addition to all the ranges broken, that's fine too. Then it's really super confirmed. But you can use your indicators again to help confirm what you're seeing with your trend lines and help your decision making by combining and using other indicators when they happen. So that's a little bit about identifying trend lines or identifying false breakouts. Not easy. It is the number one challenge out there. But if you can start using some of these ideas, you can decide, and based on your own risk profile and what you want to do and how you might manage your trades, to start deciding like, okay, how is that going to affect my decision making? Again, if the trend line rule is broken, you can always use that rule, established rule. But if you want to try to see if a false breakout is happening, use some of these ideas and see what happens. And you might be rewarded in terms of, let's say it's an uptrend and it picks back up, or you might have taken a little bit more loss, hoping that the false breakout wasn't really occurring, and you wanted to let it prove itself a little bit, and it ended up being a real breakout. And then you need to act accordingly too, with that extra confirmation.